All right, welcome to Iron Financial. This is where we forge stronger portfolios by cutting right through all the market weakness. And today, man, we've got a really interesting one. We are putting Marriott International under the microscope. Their latest earnings report, it's a total paradox, the kind of thing that would make most investors run for the hills. Think about it. They missed their big headline number, their earnings. But the stock? It didn't just go up a little, it absolutely surged. We're talking one of its best days in a long, long time. Now, a signal like that, you can't ignore it. It demands a full investigation. So our mission today is simple. We're going to pop the hood, we're going to dissect the engine, and we're going to figure out if this massive move is built on a solid, ironclad foundation, or if it's just a bunch of market hype that's about to come crashing down. Let's get to work. Whoa, hold on. Let's just cut right to the chase here. Are you seriously telling me that a company like Marriott, we're talking about a global giant, a bellwether for the entire travel industry, misses its earnings per share target? You know, the one number that every single analyst on Wall Street is obsessed with, and the market's reaction is to hand them a 9% rally? That doesn't just sound like a paradox. It sounds nuts. It's completely irrational. Look, in my book, an earnings miss is a huge red flag. It means something went wrong. It's a crack in the armor. So what on earth is going on? Is the market seeing some kind of hidden strength that the rest of us are missing? Or is this just a classic bubble, irrational exuberance that's going to absolutely torch anyone who gets in too late? I need the real story here, not just the headlines. And you're asking exactly the right question. You have to. Look, the numbers right here on the screen, they paint this picture perfectly. It's a total contradiction. On one hand, you've got the Q4 adjusted earnings per share. Marriott delivered $2.58. The street, the consensus, they were looking for $2.61. Okay, so let's be real about this. It's a 3-cent miss. A 3-cent miss on a number that's over $2.50. That's a miss of just over 1%. In the grand scheme of things, you could almost call that a rounding error. But then you look at the other side of the slide, the stock's reaction. It wasn't a 1% drop. It was a massive jaw-dropping 9.1% surge. See? These two things just don't add up. They don't compute on the surface. To figure this out, we have to ignore the headline noise and really dig into the structural integrity of the business itself. See, that's the thing. The market isn't being irrational. Not at all. This was a cold, calculated bet. You have to understand, the big money, we're talking the institutions, the funds that move billions of dollars, they looked at that tiny little 1% miss on the EPS, and they basically said, so what? They just tossed it aside like it was nothing, like statistical noise. They weren't betting on the past quarter. They're betting on the fundamental underlying strength, and more importantly, where this company is headed. They looked right under the hood of this report, and what they saw was a powerful, fine-tuned engine that can easily power through a tiny little hiccup. Our job now is to find out if they made the right call. A powerful engine? Come on. I'm not sold on that at all. For an engine to be powerful, it has to be firing on all cylinders, right? And a miss, I don't care how small you try to make it sound, a miss is a misfire. It's a spark plug that didn't fire. It means something's off. Maybe the timing's wrong, maybe the fuel mix is bad, but something isn't working the way it's supposed to. So before I'm ready to buy into this whole powerful engine story, you're going to have to prove to me that this little misfire isn't a sign of a much bigger, much more expensive mechanical problem waiting just around the corner. Let's get our hands dirty. Let's get into the guts of this thing. You know what? I couldn't agree more. Let's do it. Let's pop the hood, and the very first thing we have to inspect, the first component we need to analyze, is the single most critical performance metric in the entire hotel business. I'm not exaggerating. This is the true measure of a hotel company's health, its efficiency, its power. And this is where the real story starts to come into focus. I'm talking about RevPAR, revenue per available room. Forget the feelings, forget the forecasts. This is about the cold, hard reality of how well they're filling their rooms and how much they can charge for them. Okay, let's just take a second and make sure we're all crystal clear on what RevPAR is, because honestly, it is the absolute bedrock of this whole investigation. It's actually pretty simple. You take the average price of a room and you multiply it by how many of your rooms are full. That's it. But what it does is it cuts through all the other noise. It tells you for every single room you have on the planet, doesn't matter if there's a guest in it or not, how much money that room is bringing in. It combines your pricing power and the actual demand from customers into one clean, powerful number. If RevPAR is going up, your core business is strong. If it's going down, you've got trouble. It really is that simple. Okay, fine. I get it. RevPAR is the gold standard. But come on, a single worldwide number? That's just an average. And averages are great at hiding the ugly truth, right? A really strong market can totally paper over the cracks in a weak one. And Marriott is a global empire. So I don't want the blended, sanitized number. I want the real breakdown. I want to see what's happening on their home turf, the US and Canada, versus what's going on everywhere else. Is this whole structure rising up together, or is one part of the foundation sagging while another part is trying to do all the heavy lifting? Don't give me the average, show me the map, show me the split. Now we're talking. Now we are getting right to the absolute heart of the matter. This chart right here, this tells a massive part of the story. Just look at the difference. It's night and day. Over on the left, you've got the US and Canada. This is Marriott's biggest, most established market. And what do you see? It's basically a flat line. It's actually down a tiny bit, 0.1%. Now, if that was the entire story, this stock would have gotten absolutely crushed, no doubt about it. But it's not the whole story. Look over to the right. Look at the international business. That is not just growth. That is a rocket ship. We're talking a 6.1% jump in RevPAR. This isn't just a little bit better, it's a completely different universe. The international engine isn't just firing on all cylinders, it's redlining, and it's pulling the entire weight of the company with it. And you know what? Let's drill down even deeper, because this is where it gets really, really interesting. This isn't just one lucky hotspot carrying the whole team. No way. We are seeing solid, broad-based strength all across the globe. Just look at these numbers. The Middle East and Africa, they're on fire. RevPAR is up a staggering 12.8%. Then you've got Asia Pacific, and this is even without China, up a super strong 8.8%. And even in the older, more mature markets like Europe and Greater China, you're still seeing solid, healthy gains of 3.4%. What this proves, without a shadow of a doubt, is that their global diversification plan isn't just a talking point, it's a massive structural advantage. The US market might be taking a breather, but Marriott has built a global growth machine that is more than picking up the slack. So, you see, that international growth engine, that's the first major pillar of strength we've uncovered. But the second one, and you could argue it's even more important for the long-term health of the company, is the fundamental design of the business itself. And you don't have to take my word for it. The CEO, Anthony Capuano, he says it right here. It's a fee-driven, asset-light business model. Now look, I know those sound like corporate buzzwords, but they're not. This is the actual architectural blueprint that makes a company like Marriott a financial fortress. Let's break down what that really means for you as an investor. Okay, here's how this cash machine is put together. It's brilliant in its simplicity. Step 1, asset light. All that means is that Marriott doesn't actually own most of the buildings. They are not in the business of spending billions and billions of dollars on land, concrete, and steel. That's a super expensive and super risky game to play. So what do? Step 2. They collect fees. They license out their incredibly powerful brand names. We're talking the Ritz-Carlton, Sheraton, Westin, names people know and trust all over the world, to property owners. And those owners pay Marriott steady franchise and management fees. Which brings us to the big payoff, step 3. This creates an unbelievably high-margin, predictable river of cash. They get a slice of the revenue without having to carry the huge costs and risks of actually owning the hotels. It's a beautiful model. It truly is a cash-generating fortress. All right, I'll give you that. A 7% jump in gross fee revenue, hitting $1.4 billion in just one quarter, that's a seriously strong number. I can't argue with the math there. The cash machine is obviously switched on and running well, but, and this is a big but, a strong engine doesn't mean a thing if the frame it's sitting in is all rusted out. It's still a bad investment. So where is all this cash going? Are they being smart with it? Are they disciplined? Or are they just taking on more and more debt? Because a great business model can be totally destroyed by a weak financial foundation. It happens all the time. So let's get away from the revenues for a minute and let's stress test that foundation. Show me the balance sheet. That is exactly where we need to go next. You're 100% right. Any complete analysis has to move from the engine to the chassis. We've seen the power, now we need to check the foundation. How are they managing all that cash? What's the debt situation look like? Because this is where you really separate the solid, well-built companies that can weather any storm from the ones that look good on the surface but are ready to crumble at the first sign of pressure. It's time to put the balance sheet to the test. So, the argument for a strong balance sheet, the bull case, is incredibly compelling, and it starts with this one giant number: $4 billion. That's how much cash the company handed directly back to its owners, the shareholders, in 2025. That's a mix of dividends and stock buybacks. Now think about what that means. This isn't some vague promise about future value. This is cold, hard cash being put right back into investors' pockets. It's also a huge signal of confidence from the management team. They're basically shouting to the market, we generate so much cash that we can fund all our global growth, we can service all our debt, and we still have billions of dollars left over to reward you, our shareholders. That's a powerful statement.
Whoa, 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 hit the brakes. Confidence is one thing, but debt is a cold, hard, undeniable fact. And this fact is a big one. $16.2 billion in total debt. But here's the part that really gets my attention. It's not going down. It's growing. It's up $1.8 billion from where it was at the end of 2024. You can't just gloss over that. Look, returning $4 billion to shareholders sounds fantastic, but if you're piling on almost $2 billion in new debt on the other side of the balance sheet, it begs a really important question about sustainability. Are these shareholder returns being paid for by strong performance, or are they being paid for with borrowed money? Because that is a critical difference for anyone thinking about this as a long-term investment.
And that right there, that brings us to the core conflict of this whole thing. We've got two very powerful, very real forces pushing against each other. On one side, you've got this beautiful, high-margin, cash-gushing business model that's returning billions to its owners. But on the other side, you've got this growing mountain of debt. So what's the verdict here? Is this balance sheet a solid foundation that can actually support all this future growth and keep those shareholder returns coming? Or is that $16.2 billion debt load a heavy, heavy burden that's starting to put some serious cracks in that very same foundation? The answer to that question tells us if this is a durable, long-term opportunity or if it's just a trap waiting to spring. You've just framed the entire debate perfectly. And the market, the smart money we talked about, they answered that question. But they didn't do it by looking in the rearview mirror. They did it by looking ahead. The real reason, the true catalyst for that huge stock surge, it had nothing to do with the Q4 numbers we just looked at. Not really. It was all about the company's guidance for the year to come. It was about the 2026 blueprint. This is where the company lays out its construction plan for the next 12 months, and it's what gave investors the confidence to look right past that rising debt and that tiny earnings miss. Now, this slide is really the key to the whole puzzle, but you have to know where to look. Check out that top line, the adjusted EPS guidance for 2026. Marriott's midpoint is $11.45. Wall Street was expecting $11.45. It's exactly in line. No surprise there, no reason for the stock to move. But now, look at the next line down. Adjusted EBITDA. Remember, EBITDA is a much pure way to measure the raw cash-generating power of the business. It strips out stuff like interest on debt, taxes, and non-cash accounting quirks like depreciation. It just shows you the health of the engine itself. And here, Marriott guided to a midpoint of $5.89 billion. The street was only looking for $5.72 billion. That is a big, meaningful beat. It was a clear signal to investors that the core profitability and the cash flow are going to be even stronger than anyone thought, giving them the confidence that the company can easily grow and handle its debt. That EBITDA beat is the smoking gun. Okay, I have to admit, that forward-looking plan, that blueprint, it's pretty solid. They're not just forecasting better than expected profits, they're putting concrete numbers behind their growth strategy. They're telling us they expect to see continued RevPAR growth all over the world, even if it's a bit slower. They're projecting really healthy net rooms growth somewhere between 4.5% and 5%, which means their global footprint is still getting bigger at a pretty fast clip. And maybe the most important part, they are explicitly telling shareholders they're going to increase the cash they return to them to over $4.3 billion. When you add all that up with that EBITDA beat, it really does paint a picture of a management team that has total confidence in their construction plan for the year. They aren't just sitting back, they're actively building on their success. Exactly. So, now it's time to put all the pieces together and deliver the iron verdict. We started this whole thing with a paradox, right? A tiny earnings miss that led to a giant stock surge. We dissected the engine, and we found that a booming international business was doing all the heavy lifting for a flat domestic market. We looked at the business model, and we found a fortress that just prints cash. We stress-tested the balance sheet, and we found this tension between big shareholder returns and rising debt. And then finally, we looked at the 2026 blueprint, which completely resolved that tension by pointing towards even greater future strength. So let's wrap this up. So the bottom line is this. The bull case, the reason the market cheered, it all stands on three incredibly solid pillars. First, you've got that powerful international engine, proving how valuable a globally diversified company is in a world where different economies are growing at different speeds.
Second, that asset-light business model is just incredibly resilient. I mean, it is structurally engineered to pump out massive amounts of free cash, which gives the company a ton of flexibility to reward shareholders and still invest in future growth.
And third, and this was the clincher, that confident 2026 blueprint, anchored by that critical EBITDA beat, sent a clear, undeniable signal to the market. It said that future profits are secure, and that allowed everyone to look past the tiny flaws in the current report and value the stock based on a much stronger future. So here's the iron financial verdict. It's clear. The market's huge reaction wasn't irrational at all. It was smart and it was forward-looking. This is a trend we're seeing more and more.
Sophisticated investors are prioritizing clear line of sight into future cash flow, and they care less about tiny, backward-looking misses on EPS. They looked at Marriott, they saw the underlying structural strengths, they saw the positive future outlook, and they correctly decided that all of that far outweighed one little blemish on a quarterly report. This isn't a story about hype. This is a story about a company built on a solid global foundation, with a powerful business model and a very clear plan for future growth. The market sniffed out an opportunity, and our deep dive confirms it was built on solid ground. I agree. The foundation looks solid right now, but let's not get carried away. We can't just ignore what's happening in the outside world. The sources themselves point out some big risks looming on the horizon. You've got macroeconomic pressures like sticky inflation that could squeeze people's travel budgets. You've got certain markets getting saturated, and you have brutal competition from the other big hotel chains. So the final question we'll leave you with is this. The structure looks sound today, but can it actually withstand the storms that are gathering out there? Because every strong portfolio has to be constantly stress tested against what's coming next. Can Marriott keep building higher and higher, or will these outside pressures finally test the limits of its foundation? That remains the multi-billion-dollar question.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.